everyone.
Good morning, everyone, and welcome to our session today on COVID-19. COVID-19 has had a massive impact on the world as we know it, on a personal front, on a business front, and today we're going to be talking about the financial statements impact thereof. Before I introduce the team, let's just explain some rules. The first one is, as you've noticed, you've all been silenced, so please use the chat box if you'd like to ask any questions. We'll chat through them and try and respond to them as soon as we can and at the appropriate times. Please, our videos are going to be off throughout the session. We'll put them on to introduce ourselves, and then out of respect for everyone's bandwidth, we're then going to switch the video off and just have our slides on. Also, just to confirm, we do have an attendance register. It is taken automatically when you log on, so everyone's okay on that one. Right, so today most of my team will be presenting different sections. Let's start by introducing myself. My name is Justine Kornbrink. I head up the IFRS team. And yeah, we've been going for a number of years now, and as I said, you're going to meet quite a number of my team today. So let the team introduce themselves. Susanna, would you please introduce yourself?
Morning, everyone. My name is Susanna, and I am a partner in the Quality and Risk Management Department, specializing in IFRS, and I'm based in Cape Town. Sonika, over to you.
Morning, everyone. My name is Sonika Skuman. I'm a director, and I am based in the Johannesburg office. Carolina?
Good morning, everybody. My name is Carolina Martin. I'm an IFRS Senior Manager, also based in Johannesburg. Nelia?
Good morning, I'm Nelia and I'm based in our Cape Town office. Back over to you, Justine.
Thank you, everyone. Thank you, ladies. Okay, so today we're going to talk about a number of topics relating to COVID. Susie, will you do the next slide, please? Thank you. So we're going to talk about subsequent events and going concern, non-financial assets, income tax, provisions, revenue recognition, financial instruments, and presentation and other implications. So each lady is going to be doing different sections hereof, and I think we're going to just jump straight into the subsequent events. Next slide, please. And thank you. Okay, so, I mean, as we all know, COVID became a public health emergency on the 30th of January 2020, and on the 11th of March, it was declared a pandemic. Countries have had very different containment plans, different times, different decisions around the world, and the decisions and announcements by government have been different in some centres. All of the annual financial statements or interims since 31 March have to have accounted for COVID-19 as an adjusting event. What does this mean? So an adjusting event is something that happens between year end and the reporting date and affects your estimates and your judgments. So it can change the decisions that were made at year end to take into account the effects of the outbreak, these to those arising after year end. So it's very important to know what is happening and to keep your finger on the pulse throughout the time, because you might make a decision that the useful life of these property, plant and equipment is 10 years, but due to COVID, they're not getting used, and therefore the period can get extended. And some of this, it happens after year end. So if you had a February year end and everything happened in March, it wouldn't have been something that you expected at that time. So that would not be. But if it was at March, a March year end, then you'd have to look at it and say, well, actually, you know, COVID was very much present at that time. In South Africa, the lockdown was very much in effect. We weren't going into office. So is it actually an indicator of something that was that's just more information about what happened at year end? The other thing that we need to always look at is going concern. Now, going concern, you need to assess for, you need to assess it right until the day that the financial statements are authorized for issue. And what's interesting about the going concern assessment is that you will still, if you decide going concern is not applicable, you still have to change it in your annual financial statements, even if that going concern decision changes. Let's say your financial statements are end of March and we now, well, then we get to June and something happens then. If the decision is made before the financial statements are published, that still needs to be adjusted for. Next slide, please, Susie. So when you're looking at going concern, you always look at a number of things. So you'll look at what happens before and after the financial statements are issued, or after year end, sorry, or period end. And those are, you have to always look at, you know, we look at if something's an adjusting event or non-adjusting event, and that does not impact whether something is adjusted for going concern. It would still be adjusted for going concern, even if it was an event that wasn't indicative of things that existed at year end. So factors that get considered are the existing factors and anticipated impacts, in this case of COVID, on the economic conditions of an entity. So you would consider things like a decrease in revenue, erosion of profits due to significant increased unforeseen expenses, breach of debt covenants, cash flow issues, expected impacts of announcements of governments. Those sort of things would all come into consideration when you're looking at the going concern. Next slide, please. So when you have a look at that, then you go on to the next consideration and say, well, is it actually a going concern? Is the company still considered a going concern? And some of you would have already seen the auditors are questioning and need to question properly whether you are a going concern, whether there are material uncertainties of going concern, and those sort of things need to be disclosed. So if the going concern is compromised, and it's definitely not considered that way, then you have to disclose it in your financial statements, and you have to then, you can't prepare your financial statements on a going concern basis. And this considers the business perspective together with IFRS guidance. The financial statements, you still need to look at all times from both perspectives. IFRS does not provide guidance on how to measure assets and liabilities when a going concern assumption is not applied anymore, but there is a lot of acceptance guidance and rules out there that people are applying. When do you abandon the going concern assumption? The going concern assumption must be abandoned or shall be abandoned if the reporting entity, so in other words, if you're in a group situation, if the holding company has no realistic alternative but to liquidate or cease trading. If a subsidiary of the group is about to be liquidated, but the holding company is still able to continue as a going concern, then the consolidated financial statements of all group entities shall be measured under going concern assumption. But you will then take into account whether IFRS 5 discontinued ops needs to be considered. Next slide, please. So what do we disclose? And this is where things always get interesting, because you'll all have heard people saying, well, where's your COVID-19 disclosure? What needs to come in? And the key principle to this is that you need adequate and relevant disclosures. And the JSE and ESMA have said, well, you really need to have quantitative and qualitative information in your financial statements about the impact of COVID-19 on your company, on the going concern of your company, on your ability to continue, and what is happening, what is going to actually impact the decisions of your shareholders. So those are key concepts to really take into account. You've got to measure the risk of material adjustment in the next financial year. That's the essence of it. So you will need to disclose information about non-adjusting events, sort of the nature and the estimated effect or financial effect of those non-adjusting events. And if you can't, then you need to state that you can't and why. Information about the assumptions for future and estimated uncertainty, information about going concern, either the fact that you're no longer a going concern or the material uncertainties that cast doubt on a going concern, but without questioning the relevance of the going concern assumption. So it's always a fine line to push on there. But the essence is it's got to be adequate and relevant, and it's got to be quantitative and qualitative. Okay, thank you. I think that's my side. I'll hand over to Nelia now.
Okay, so if we look at the impact of COVID-19 on impairment, IAS 36 requires us to assess at the end of each reporting period whether there's any impairment for an entity's non-financial assets. For goodwill and intangible assets with an indefinite useful life, the standard requires an annual impairment test and when there's indicators of impairment. And for many entities, COVID-19 has actually resulted in an indicator of impairment, as COVID resulted in a fall of stock prices, manufacturing plant shutdowns, shop closures, and a reduced demand and a drop in selling prices. So COVID-19 can have quite a significant impact when it comes to the impairment of non-financial assets. For listed entities publishing interim financial statements, you already at the interim period need to assess whether there's impairment, especially of goodwill. And it's also important to take note that if you do impair your goodwill, you won't be able to reverse that at a later stage. For non-listed entities, you actually have till your year end to assess whether there is an impairment of your non-financial assets. To calculate the impairment, you need to estimate the recoverable amount of the assets. And in terms of IAS 36, this is the higher of the fair value less cost of disposal and the value in use. The value in use is quite often used to determine the recoverable amount. And due to the impact of COVID-19, there are several judgments that you will need to make in order to determine the expected cash flow in order to calculate the value in use. Some of the expected cash flows could, for example, relate to government assistance, and you will need to understand the terms of the financial support received from government and consider what assistance you will receive and for how long. In estimating cash flows, you will also need to make judgments on how changes in contracts with customers will affect the expected future cash flows. Cash flows can be lower or be delayed, which will impact the recoverable amount. And the forecasted cash flow should reflect management's best estimate at the end of the reporting period of the economic conditions that will exist over the remaining useful life of the assets. We would therefore actually expect that the budgeted plans for at least 2020 and 21 will be updated, since COVID-19 is expected to affect these 2 years at a minimum. Some of the key assumptions that you will need to consider in making forecasts is the duration of the crisis, the recovery curve, and the expected date of normal performance of the business. These are all significant judgments that you also need to consider for disclosure in your financial statements. So if we go to the next slide, we have more indicators that you need to take into account in the impairment assessment as well as on disclosure. So with the current uncertain situation, we are expecting significant challenges in preparing the forecast of budgets and future cash flows. An approach which you can adopt under these circumstances is an expected cash flow approach based on multiple probability-weighted scenarios in estimating value in use. This may reflect the current uncertainty better than using a single best estimate, but you're still definitely allowed to use a single best estimate. For the multiple probability weighted scenario, you will prepare several cash flow forecasts for different scenarios. And this can be quite useful if you're unsure of the recovery curve of the business. If it's not possible to set up several sets of assumptions, then the discount rate should be adjusted for the effects of COVID-19. It's just important that whichever approach you adopt, that you don't double account for the effect of COVID-19. So you don't adjust the discount rate for the same risks that you've already incorporated into the cash flow, because then you would actually be double counting for the effect of COVID-19. When it comes to the discount rate, usually the WACC rate is used, but then COVID-19 can also have a significant impact on this rate because it's likely to affect the risk-free rate and the entity-specific risk premiums. In some jurisdictions, we've actually seen that the risk-free rate has decreased since it's linked to yields on government bonds, but that is not the case in all jurisdictions. And that would also not necessarily result in an overall decrease in your discount rate, since we expect that the risk premiums for many entities would actually increase due to volatility in markets and changes in earnings yields. So overall, we actually expect to see an increase in discount rates. Then, like I said previously, it's very important to actually disclose the assumptions that you've made. IAS 36 does require extensive disclosure as well as IFRS 13. And this includes a description of each of the key assumptions you used in determining the cash flow projections for the period. Key assumptions are those to which the asset recoverable amount is most sensitive to. If we look at the financial statements that have been published recently, then some of the key assumptions that we see is, if we look at, for example, the airline industry, they are disclosing when they expect domestic travel to resume, when international travel will resume, and when the entity is expected to return to pre-COVID profitability levels. And those are all items that you take into account in determining your cash flow or that will impact your discount rate. So those are the things that you can consider for disclosure. Are there any questions at this point? If there are, then you can just pop them into the chat box and we can address them.
Nelia, there's no questions at this time.
Okay, if there's no questions, then we can move on to the next section. Okay. So when it comes to inventories, we should also assess inventory for impairment as a result of COVID-19. So inventory is recognized at the lower of cost or net realizable value, and indicators that the net realizable value of stock has dropped below the cost could be due to a change in the consumer consumption patterns, decreases in selling prices, and the perishability of goods. So if you were not able to sell goods during the lockdown period and they were perishable goods, then of course you would have a write-off of that inventory. If we look at our farming industry, currently the export market has dried up for produce such as avocado exports, and it's also actually very expensive to transport goods from the harbour for export. So usually what happened is companies transported goods from the harbour inland, where they picked up the agricultural produce and transported that back to the harbour for exports. But with the decrease in imports overall, some of the producers actually need to fund the full transport of the agricultural produce to the harbour, where that was split amongst many entities in the past. So it has become quite expensive to actually export goods, and there was a decrease in demand as well. So that could indicate that your net realizable value is actually decreased. And if you look at agricultural produce, the local market selling prices are usually much lower than the export markets, and that's what you would then need to use in determining your net realizable value. So your net realizable value is a link to the market that you actually expect to sell the goods in. So that could also be an indicator of impairment. This is just one example. There could be many more. And what is also important is to identify wastage in the production process where the business is not operating at normal capacity. So wastage or excess overhead should not be included as part of your inventory and should be expensed immediately in the statement of profit and loss. This would, for example, be where your company leases a factory but was not able to manufacture goods during the lockdown period. So the overhead cost relating to the building should be expensed in this case and not be capitalized to inventory. What we would also recommend is that you actually disclose the wastage separately and not include it within cost of sales. Okay, is there any questions at this point on inventory?
No questions on inventory.
Okay, let's move on to depreciation of assets. So most companies have actually adopted the policy of depreciating property, plant and equipment on a straight line basis over the useful life. If you are depreciating assets on a straight line basis, you will have to unfortunately continue depreciating the asset even when the asset is not in use during the lockdown periods. IFRS is very clear that idle assets should still be depreciated. If you have selected the policy of depreciating the asset based on effective usage, then you would not need to depreciate the asset if it has not been in use. Depreciating assets using the effective usage method is common in the mining industry, but overall we mostly see that assets are depreciated on a straight line basis. Another factor to consider is whether there was changes in the useful life or residual values of the property, plant and equipment. So for example, if an asset was not in use during the lockdown period, then there was less wear and tear on that asset, and that could possibly extend the useful life of that asset. So it's also important to assess whether there was a change in the useful life. Also, changes in the markets might impact the residual value of your property, plant and equipment, which can also impact your depreciation. So those are also items to look out for. Okay. If there's no questions on the depreciation of assets, then we can move to tax. Okay. Next slide, please. From a tax perspective, it's very important to assess whether you still will be able to utilize deferred tax assets raised on assessed losses. This will be very important if you are projecting future losses. So IAS 12 requires us to assess whether there will be taxable profits available against which we can utilize deductible temporary differences. If it's not probable that there will be taxable profits in the near future, then you cannot recognize a deferred tax asset on the assessed losses. So we are actually expecting to see the derecognition of many of the deferred tax on the assessed losses previously raised, especially for companies that are projecting losses going forward.
Sorry, Nelia, just a quick question. So deferred tax assets are a major focus area at the moment. How can preparers make sure they're ready to deal with the questions that need to be dealt with, that need to be answered?
Okay, so in this case, I would say it would very much link back to your forecast and your budgets, and very much the same information that you would use in your impairment assessment. And if you are actually expecting the company to make consecutive losses for, let's say, the next 5 years, then it becomes very unlikely that you will be able to utilize assessed losses, because the losses are then expected to only increase. And then it would be very unlikely that you can make a strong argument to actually recognize a deferred tax asset on assessed losses. So the longer the period is that you are forecasting losses for, the less likely it becomes that you can actually recognize an asset. If a company has a strong recovery and you can already see an improvement and that you are projecting profits in, let's say, the next 3 years, then I would say there's a possibility that you can still recognize your deferred tax asset, but it very much dependent on what the forecast taxable profits is. So that's also important. This is about taxable profits, not just the profit as it's stated in the financial statements, the accounting profit. So it needs to be taxable profit. So you also need to consider any other adjustments and whether that will be tax deductible or not.
Cool, thank you.
Okay, and that concludes, I think, my part of this session. So I'm handing over to Sonika now.
Thank you, Nelia. So provisions. Provisions is one of those interesting topics because obviously all of our expenses are increasing quite substantially as a result of COVID-19. And the question is, when can you raise provisions, what can you raise provisions for, and so forth. So the first question is, what about future operating losses? I mean, we all know this from our university days that IFRS and specifically IAS 37 specifically precludes the raising of provisions for future operating losses. But wow, the temptation would become quite big at this point in time and in this economic environment. The one thing, however, that you can remember is impairment of assets. So future operating losses can be an impairment indicator with regards to, for example, your PPE, as Nelia has explained in quite a lot of detail already. The next topic to consider is restructuring. So restructuring is something that you can possibly raise a provision for. However, you need to remember that there needs to be a fundamental change in the business before you can actually raise this provision. There needs to be a present obligation and you need to be able to make a reliable estimate. So in practice, what this means is that the standard requires there to be a detailed formal plan to be available to indicate that you've met this criteria. So some of the things that needs to be taken into account and need to be addressed in this plan is, for example, which businesses will be shut down or changed, the location of these businesses, number of employees, what are the expenses that you are taking into account, and also the timing. So the timing doesn't have to be necessarily very quick, but it needs to be planned to start implementing this plan within a time frame that makes it significant that significant changes to the plan will in fact be unlikely. Termination benefits is another thing to take into account, and the standard actually links the recognition of termination benefits to the timing of when you meet the criteria for raising the restructuring provision. So again, it must be within a time frame that it is not likely that this plan will in fact be withdrawn. The next topic to keep in mind here is with regards to onerous contracts. So obviously your costs to fulfill your contracts may in fact now be longer than what it was previously. This is more of an IFRS 15 flavor to it, and specifically your overtime contracts. And the lockdown could obviously result in such an increase in your costs. So essentially what the standard requires you to raise a provision on is when your unavoidable costs will be more than the benefits that you are expecting to receive as a result of this contracts. As I mentioned, it's predominantly relating to your IFRS 15 contracts, but there can also be other types of onerous contracts, for example, onerous lease contracts and so forth. Some of the things to take into account in these types of contracts is, for example, your early termination clauses. If you can cancel it without any payment, then it would not actually be an onerous contract. Also remember your force majeure contract clauses, meaning that if something horrible happens, you can actually exit out of the contract. There's no one-size-fits-all relating to these, though. So you need to look at each of these contracts individually to check whether or not they would meet the criteria to be raised as an onerous contract. Any questions?
I think I'll just add in one comment that the majority of onerous contracts that we've seen at this point are due to companies consolidating their businesses, and so a lot of it is lease contracts related, but there have been a few revenue related contracts that we've seen as well.
Thank you, Justine. Next slide, please. So with regards to employee benefits, there's a couple of things to take into account here. The first one is that obviously you could be in a position where you are still incurring the same volume of employee benefits expenses, but for a reduced amount of activity. So that can be, for example, you've continued to pay your salaries for your employees when they had to stay at home during the forced shutdown under level 5. And specifically with regards to employees that can actually not work from home. The other expense that relates to this is, for example, if there's absences with regards to people taking sick leave when they maybe sadly have contracted COVID. And the important thing to remember here is that you cannot raise a liability with regards to these expenses. These expenses are required to be incurred only when the absence actually occurs and the cost is therefore incurred. With regards to share-based payments, obviously there's a couple of things that can take place in a COVID environment. The first thing is that there can be a decline in the activity. So if, for example, there is a vesting condition incorporated into your share-based payment, relating to, for example, a sales target or EBITDA, that is in fact a non-market vesting condition, and effectively that adjustment would be taken into account by possibly reversing that portion of the expense relating specifically to that vesting condition. Careful, however, because the other thing that is very often included or most commonly included in share-based payments is that the target is actually linked to the share price. And that is in fact a market vesting condition which has been taken into account in the grant date fair value and is not linked to the possibility that the condition will in fact be met. So those types of expenses will in fact not be reversed. So again, not a one-size-fits-all with regards to share-based payments. Have a look very carefully as to what exactly are the vesting conditions incorporated into your plans, because the accounting for them can be quite different depending on how exactly they were worded. Pension liabilities, the thing to take into account there that comes to mind very quickly is that the South African interest rates have decreased quite substantially ever since the lockdown has started and the pandemic has been declared. And that has obviously been in an effort by the government to try and bring down it's been in an effort to try and increase economic activity, bring down the inflation in the country, and therefore trying to stimulate economic growth within the country. So how does that link back to your pension liabilities? Pension liabilities would obviously need to be discounted because they are long-term employee benefits, and therefore your discount rate may in fact have to change. So what I would recommend you to do is when you get your actuarial report from the actuaries and the discount rate is exactly the same as it was last year, ask the actuaries if that is in fact correct, if that shouldn't be adjusted to some extent, because that is a question that we are commonly asking when we look at financial statements. Any questions?
There's no questions at this time, Sonika.
Okay, thank you. Next slide, please. So the next topic is my favorite one. It's on revenue recognition. Obviously, the main impact that we are seeing is that revenues are decreasing, and in most cases, that would be fairly straightforward in terms of accounting for it. You're selling less goods, therefore your revenue is decreasing, and that's the end to it. However, there can be some implications, especially to your longer term contracts, and there's a couple of things that you would need to consider in this regard, and also with regards to your non-run-of-the-mill type of contracts in terms of IFRS 15. So we're not seeing as many questions as I thought we would, but there are some things to consider. The first thing may look a little bit funny because, as you would see on the slide, it talks about the existence of a contract with a customer. Now, obviously, there is a contract with your customer, be it by way of a sales invoice, being the toll slip, or a formal contract with the customer. Why are we asking this question? The reason is because IFRS 15 talks about, it takes a slightly different approach to this question on whether or not a contract actually exists. Now, we are currently looking at step 1 of the IFRS 15 5-step model. IFRS 15 says that there's one of 3 possible situations that can take place when you're looking at credit risk and whether or not the contract actually exists. On the one extreme, it says that if it is not probable, and not probable meaning less than 50%, that you're going to get your money out of this contract, IFRS 15 says that there's a possibility that the contract may in fact not exist at all, meaning that you don't recognize any revenue unless certain specific criteria are met, which I'll get to later. On the other extreme, you get the situation that we all know and love, meaning that you are recognizing your revenue, and when the credit event takes place at a subsequent point in time, you then recognize your impairment loss, your ECL, which is the topic that Carolina will be talking a lot more on later during this presentation. And then there is this funny in between, which IFRS 15 incorporated, which is actually in step 3 of the model. And that is the so-called price concession. What this essentially means is that you know you're going to get something out of the contract, but it's not going to be your full contract price, and you're actually willing to accept it. So we've not seen a lot of these price concessions in a lot of contracts, but it is something that you would need to consider, especially if you are selling to, for example, a new market, and you are still willing to negotiate in terms of what you would actually accept as payment for the contract. For example, if you are still busy establishing the price, you're selling, for example, goods that are still in a development phase, there may be lots of negotiation taking place with regards to the price that you are going to receive out of this contract, and it may not actually be the price that is stipulated on paper in the contract. With regards to the impact of credit risk, there is also specific criteria in the standard talking about what happens if you've already handed over control over the good, or it's a long-term contract and you are busy handing over control, and there is all of a sudden a significant decline in credit risk. And what this effectively means is that when you look at the definition of a contract, meaning that it must be committed to by the parties, and the payment terms must be identified, the parties must be committed to perform in terms of the contract. One of those criteria is the probability one, which I alluded to earlier in this discussion, probability that you will be collecting the future cash flows to which you are entitled. And if you now subsequently reach the point in time where you're not so sure that you are actually going to get all of your cash flows out of this contract, you need to at least ask the question if you're still meeting the criteria to define the contract. You would only do this reassessment, however, if there has been a significant change in the facts and circumstances. And such a significant change can possibly be a significant decline in the credit risk. What the standard says is that you do this assessment on a prospective basis. So any revenue that you have already recognized in terms of this long-term contract, you would not reverse that. Any receivables that you've already recognized, you would not reverse that from an IFRS 15 perspective, or any contract assets that you have recognized. And you would only recognize the revenue going forward when you have when the remaining obligations have been substantially met in terms of that specific portion of the contract, or substantially met. And also any money that you have received is non-refundable. That's the one possibility. The other possibility is that the contract has been terminated and any consideration that you've received is non-refundable. So it's essentially a type of a cash basis of accounting for your contract. It is something that is somewhat rare, and it is quite complex to actually assess these facts and circumstances. Extremely judgmental, obviously. So you would need to be very careful in terms of your assessing of these contracts. And I would recommend that you reach out to your auditors to help you making these significant judgments and estimates. Also, if you now further on conclude that you do actually meet the criteria of the definition of a contract, then you would simply continue to apply the 5-step model on a cumulative basis, or actually on a cumulative catch-up basis, and take the contract as per usual going forward. Okay, that's quite a mouthful. With regards to contract modifications to contract terminations, it's important to remember that a termination is, in terms of the way that IFRS 15 is structured, it is also regarded as being a type of modification. What you would do there is any amendments to the prices, the scope, or both. There's a very complex model that you would need to assess in terms of the contract to assess these types of modifications. Essentially what that would mean is that you could possibly sit in a position where it's a new contract, possibly a position where you need to combine the existing contract with the new contract and do a cumulative catch-up. Alternatively, it could be that it is a termination of the old contract and establishment of a new contract. Other things to consider is obviously, again, force majeure clauses. Judgment disclosures, very important in this type of situation. And also, if you are possibly extending your payment terms, there could be a position where you are now maybe establishing a significant financing component. So that's another thing to take into account. Next slide, please. Moving on to variable consideration or the measurement of consideration. This is obviously in step 3 of the model. The constraints. So in terms of variable consideration, there is a constraint included in IFRS 15, which effectively says that it must be highly probable that a significant reversal of revenue will not occur as a result of the uncertainties that is incorporated into this variable consideration. So the things to consider is, for example, penalties. Penalties is a very common one in a COVID-19 environment. Also, what is the actual rate of the rebate? If you are granting any rebates, what are the rates that you are granting your customers? The one common situation that I've seen on this one is business practices. What is very common is, for example, a consumer products entity would be granting certain rebates to their retailer clients. And the retailers, given the current economic environment, may in fact be struggling somewhat. And then in order to assist the retailer and to keep the retailer as such a significant customer, even though contractually they may not actually meet the criteria of the rebate. Let's say, for example, if they buy 1 million products, you give 5%. If they buy 2 million, you give them 10%. Very often you would see that the consumer product entities would still grant the 10%, even though they are not going to meet the threshold. So that is also a very important thing to take into account. What is your customary, what is your regular business practices with regards to these entities and with regards to the rebates that you are applying? With regards to retailers, a thing to consider is, for example, your rights of return. These obviously need to be estimated both from the revenue as well as from the cost of sales perspective. So very important to keep those in mind. Post-balance sheet information is very important on this one. So credit note and provisions coming from an audit background and from an audit perspective, we very often look at subsequent events in order to check if the rights of return has been measured appropriately. But it's very important to take into account which of these events are actually pre-balance sheet and which ones are post-balance sheet date, as Justine has mentioned earlier with regards to those types of events. With regards to some other things to consider on variable consideration is whether or not any significant customer incentives that may be being granted. Maybe you are giving some free stuff in order to encourage customers to buy more items. And as I mentioned, rebates can obviously, you may in the current environment grant rebates that you wouldn't have considered otherwise. So these are the things to consider on that. With regards to revenue recognition over time, this is obviously...
Sorry. Before you jump into recognition over time, I think this question fits in perfectly here. So we've had a question on, says, will pro bono provided to customers where contracts are issued that cross year end give rise to an onerous contract as salary costs exceed the benefit received?
Sure, that's an interesting one. I would expect that pro bono contracts could in fact have such an impact that it could trigger an onerous contract provision. However, it's an interesting one because you'd also need to be careful with regards to, are you not raising a provision for future operating losses? So I would not actually see it as a pro bono contract, strictly speaking, within the scope of IFRS 15, because you are not actually getting any revenue out of it. So I would then default back to the requirements of IFRS 37, which says that you cannot raise a provision for future operating losses. So I would only expense the costs as incurred. Interesting question, Justine. What do you think?
I would be inclined to agree with you. I think it ties in nicely with your measurement of revenue with the variable consideration, because it went on to then explain that it's some free work that's provided over short periods to maintain the business and the relationship. So I would also tend to agree that it's not really an onerous contract, it's more future operating losses. So therefore you recognize it as and when you incur it.
Thank you, Justine.
Thank you.
If there are no further questions at this specific point in time, and please remember that you're more than welcome to raise questions in the Q&A box. Revenue recognition over time is another, and obviously we're now sitting in step 5 of the model. Revenue recognition over time is an interesting one with regards to the measurement of progress. And the important thing there to take into account is these costs that you are incurring, are they proportionate to the satisfaction of the performance obligation? So you could in fact be incurring some inefficiencies, some production facilities that you are closing down and so forth. And the question that you always need to ask there is, are they actually contributing to you further delivering on this contract, in order to assess if they should be expensed immediately or if they should be taken into account in determining the progress of the contract. The other important thing to take into account here, and this is the one thing that keeps me awake at night in terms of IFRS 15. And this is, if you want to go and look it up afterwards in the standard itself, it's the question around paragraph 35C. So what paragraph 35C says is that you can recognize revenue over time if you meet two criteria. The first one is that the performance does not create an asset with alternative use to you. So in other words, it must be a specific asset that you are constructing or producing for a specific customer. That can also be a legal attachment to a specific customer. So if you say, for example, I'm constructing this specific unit for that specific customer, that would also suffice, even though it is of a fairly generic nature and you can actually use it for somebody else. Given the fact that it is linked contractually to a customer, you do meet this criteria. That's the first criteria. The second one is that there must be an enforceable right to payment for performance completed to date. And this is the criteria that keeps me awake at night, because you also need to take into account, for example, any case law. And given the current economic environment in the COVID world, I am scared that a lot of these contracts are going to not meet this criteria going forward, because people are not paying, and case law may in fact swerve you into a position that you will not be able to enforce these contracts. So right to payment for performance completed to date must also include a profit margin. So it's not okay to just include a clause saying that you are going to recover all of your costs. Then you would actually not meet this criteria. So if you don't meet this criteria, what does this mean? It means that you would have to recognize revenue at a point in time for all of your contracts that are similar. So again, it can get very judgmental and very difficult to actually assess this specific component, the specific paragraph of the standard. So if you've got any questions on these, I would encourage you to reach out to get help in making sure that you still meet the criteria of the standard. Next slide, please. Justine, were there any further questions?
No further questions at this time. Thank you, Sonika.
Thank you. I'm then going to hand over to Carolina.
Thank you, Sonika. Right, let's have a look at the impact of COVID-19 on financial instruments. I think the first one, let's focus on how the fair value measurement in terms of IFRS 13. We'll focus on price volatility and market activity. As long as the market is still considered to be active and transactions are non-distressed, observable market prices should still be used in the fair value in times where there's lots of volatility. However, when a valuation input is no longer considered observable, the preparers will have to consider whether there is a change in the level of the fair value, in which if there is, then there'll be additional disclosures that have to come into the financial statements. For example, change to your key assumptions, the estimates that have been used, your sensitivity analyses, etc. So those are the main ones in terms of IFRS measurement. Looking at your expected credit losses, the main consideration is obviously your decrease in the credit quality of your debtors. And as we know, through the pandemic, a lot of through the lockdowns, businesses were closed, lots of revenue has been lost, employees' salaries have been cut. So the credit quality of debtors has generally decreased as a result of this economic circumstances. So one must consider the careful monitoring of late payments, your age analysis. You need to update your analysis of your provision matrix for your trade receivables to take into account the considerations of COVID-19 and how that has actually impacted your individual debtors that you face. With this COVID-19 and from a financial instrument perspective, there is a lot of additional disclosure that is expected and also required in order to portray how COVID-19 has actually impacted your expected credit losses and your trade receivables and your other loans. Obviously, this would entail disclosure around how your forward-looking information has actually changed, how you determine your expected credit losses as a result. So it's basically telling your story, but obviously it's very company specific because not everybody's story will be the same. One more item on this slide that I'll touch on is just basically your financial guarantee contracts that are measured using the ECL model. There may be a need to reassess the current value of these financial guarantee contracts. As with this pandemic, it could change materially due to the circumstances that have come up and basically how people are not able to meet certain contracts or payments, etc. So there could be a possibility of a credit loss on these financial guarantee contracts. Justine, do you want to add anything more further to the financial guarantee contracts?
I would gladly. Thanks, Carolina. I think financial guarantee contracts is something that is traditionally overlooked in accounting, in preparing financial statements. A financial guarantee contract is a contract whereby one company has given a guarantee over the payments of another company on a specific contract. And this takes many forms, and one of the most common forms in a group is where the subsidiaries, the various entities, cross-guarantee bank accounts or cross-guarantee a loan. And what we have seen is that there's been massive impacts there when people actually start looking, because they've traditionally just ignored it. At a group level, it all disappears, so that's fine. At a company level, however, you need to assess that financial guarantee and say, well, okay, my company has guaranteed this other entity's loan account, and they're not doing so well financially at the moment. COVID has seriously impacted them. So now we need to look at that financial guarantee, and what you're required to do is you basically look at that loan that entity has and do an expected credit loss assessment on that loan to say, okay, taking into account that company's credit risk, what is the likelihood of them paying that loan and how much? And you do an expected credit loss assessment on it, and that expected credit loss amount is the amount then that you would have to recognize in your company as a liability, a financial guarantee liability. And these are now starting to come onto people's books, and they're now starting to look at it. And the big impact that is now having is that some entities are finding that the unintended consequence is that they're now in contravention of a debt covenant. So it's very important to understand these cross guarantees and what's going on within the various entities in a group, and having a proper look at this. Thanks, Carolina.
Thank you, Justine. Next slide. Great. Looking at cash and cash equivalents, I think what must focus on here is whether your cash and cash equivalents actually still do meet the definition of cash and cash equivalents. So that would be whether it is still subject to an insignificant risk of change in value, or is highly liquid. With the pandemic coming aboard, I don't think there is much, or we haven't really seen much change in terms of cash and cash equivalents. But if cash and cash equivalents do not meet the definition, then one would have to then account for an accounting reclassification in terms of IFRS 9, which may impact net debt ratios. So I think that's just something to look out for. Looking at your financial liabilities, one needs to consider debt renegotiation. So obviously now there's a lot of that happening at the moment. So one would then need to assess your financial liabilities in terms of to say, is it actually a modification? So where your cash flows have changed, so you would basically have received a payment holiday or etc. Or is it an actual extinguishment where you actually extinguish this financial liability and a brand new one liability would pop up? So a person would need to consider those IFRS 9 requirements between a modification and extinguishment. The other item, as mentioned, we've quite touched on, is the validation of debt covenants. Whether waivers have been granted or not, or whether renegotiations of these covenants are needed. In the event that there is a breach in a covenant, this may have an impact on the classification of your financial liability between a current and a non-current liability. And this obviously increases the risk on liquidity for the entity. Where there is the breach, there is additional disclosure that is required per paragraphs 18 and 19 of IFRS 17, so that needs to be also just disclosed. Next slide, please. Okay. Looking at your cash management and liquidity risk, one would have to identify the sources of funding that is available in order to secure significant future payment deadlines. This is especially a vital part for companies who have significant funding or they use funding used by the market. One has to take into account in your liquidity risk whether you have received any moratoriums or payment holidays, and basically how pressured is liquidity at the moment due to COVID-19, whether like cutting salaries, those type of things have been coming in just to try and keep the companies afloat. Another item we'll quickly touch on is also just factoring, data factoring and securitizations. From a factoring perspective, one would have to still consider whether these programs still meet the derecognition requirements of the trade receivables in terms of IFRS 9, and whether the program is still valid and sustainable. Examples of indicators to consider would be whether any late payments by debtors might lead to an early termination of the program, whether your credit insurance is still valid in light of the current catastrophe/circumstances, and whether there has been a change in your credit insurance limit. So those are the kind of things one would have to consider. From a securitization perspective, one would have to check whether the vehicle would be able to refinance itself within a market where there is a constant liquidity tension. Justine, I'm not too sure whether there's any questions at the moment or whether you'd like to add anything more at this point.
Carolina, there are no questions at the moment. I don't know if anyone has had any impacts of factoring and securitization, but an important thing to note is if you do have that, go back at this time, especially go back and check the conditions, because a lot of banks are now saying, okay, well, you're now out of the 30% recovery, so therefore this agreement is now no longer valid, so we need to cancel the factorization and you need to take back your debtors. So there have been not too many of them, luckily, but it is something that has been seen in the market. So do watch out for it and certainly keep the conversations open with your banks.
Thank you, Justine. Next slide, please. Let's have a quick look at hedge accounting, specifically at cash flow hedges. So from a cash flow hedge perspective, one would need to determine whether the hedged cash flows are still highly probable given the slowdown in activities and etc. If the hedge forecast transaction ceases to be highly probable, the hedging relationship must be stopped prospectively. Also to consider in this instance is the actual accounting treatment regarding the hedging derivative gains and losses that have accumulated in your cash flow hedging reserve within other comprehensive income. Therefore, if the hedge transaction is still expected to occur, then you maintain those gains and losses into OCI until the hedge transaction impacts profit and loss. If it is not expected to occur, then in those amounts within OCI are immediately reclassified to to profit and loss. So far in practice, I don't think we haven't seen any of this happening. I don't know if anyone in the audience maybe has any example or seen something like that, but so far we really haven't seen anything from this perspective. But I think that's the main impact in terms from a COVID perspective is basically like the slowdown activity. Are your hedged cash flows actually still highly probable? So that's just something to consider. Next slide, please. Right, so we have touched a bit throughout the presentation on disclosure, but from an IFRS 7, IFRS 9 financial instruments perspective, I just wanted to emphasize that in the context of the high market volatility, liquidity tension, and the short-term economic and long-term economic uncertainties, special attention must be paid to the disclosure that is provided in the notes to your financial statements. In regards to financial risks that impact your entity. And these risks include your liquidity, credit risk, foreign exchange risk, interest rate, market price risk, etc. All of those risks that are applicable. Some examples to consider in this context would be to provide additional information on how your significant concentration of credit risk has changed, where pre-COVID you would have had certain amount of debtors at a certain credit risk concentration, but due to the circumstances, lots of people losing their jobs, companies shutting down, those credit risk concentrations will shift and they will change. So the person needs to consider that and also disclose how that has shifted in terms of the post-COVID pandemic. Also, things to consider for disclosure is cases where there is a lack of liquidity that can have a significant impact on your going concern, as mentioned earlier. The impact of a business interruption on liquidity, I think, because that's actually quite relevant to a majority of companies that were non-essential. A description of a range available to what funding is available to you, sensitivity analysis, and I think all of these are very entity specific. And just touching on your sensitivity analysis, a lot of questions that we do ask is where we have a sensitivity analysis, say for example interest rate risk or foreign exchange risk, etc. A person usually or the preparers will put the same percentage as pre-COVID, and I think that's a question we'll ask, but is it actually reasonable to actually compare your sensitivities the same to last year, because the circumstances have changed. So I think a person should also reconsider your sensitivities in regards to your main risks. But it's also very important to emphasize that not everybody's story will be the same, because everybody has a different story to tell to tell the users. So it is very important to bring forward that story in terms of how COVID-19 is impacting your risks and your financials from that perspective. Justine, is there any questions that we can address?
And no questions, Carolina, but I would just like to add one other thing on the liquidity risk, and that is what some people are doing now, and they're not all disclosing it properly, but when you disclose your maturity analysis, you usually, the standard says you put in your financial liabilities and your financial liabilities only, unless you're using your financial assets to fund your financial liabilities. So what's happened with COVID with quite a number of people is now they're using their debtors to fund their creditors, because cash flow has become a lot tighter and it's a lot more difficult. And if that is the case, then you would need to include the debtors, your financial assets, in your maturity analysis, because it is being used to fund and to manage your liquidity risk. So that's just something to watch out for. And Carolina was talking about the sensitivities. So an example is there where you expect the interest rate, you say, well, a reasonably expected change in interest rate is 5%, and it was 5% the year before. And now with the interest rates changing so dramatically, is 5% still reasonable? And it's really to ask those questions while you're preparing the financial statements. So I think, yeah, there are no further questions on this.
Thank you, Justine. So with that, I'll hand over to Susanna, who will take us through the rest of the presentation. Thank you.
Thank you, Carolina. So the first item that I'm going to be talking about is profit and loss presentation. And one of the items that have become quite topical, mostly for listed entities, but it applies to non-listed entities as well, is the presentation of what they call alternative performance measures. So what the regulators are worried about is that entities might want to present a figure on the face of their income statement in the line of like profit before COVID. And what they're worried about is that it can be, and maybe entities in presenting that item will want to add back like unusual COVID expenses, whatever it is, in order to get to a profit before COVID figure, figure in their income statement. And the regulators are suggesting and are recommending that this isn't done, because the impact of COVID has been so pervasive that you're never really going to know what your profit before COVID would have been. It has affected your revenue, your cost of sales, your operating expenses, and if entities are going to try and present such a figure, it is not going to be comparable from one entity to the next. The other item that they have been a little bit worried about is about the presentation of non-recurring expenses on the face of the income statement or in the notes. So quite often companies want to do this because they kind of want to present a profit figure before unusual and non-recurring items, but they've warned against doing this because it looks like COVID is still going to be around for quite a while. You can't really guarantee that any of those expenses are going to be non-recurring expenses and that they're not going to occur in your next financial year again. So that is just something to bear in mind there. So the suggestion is rather to explain the impact that COVID has had in the notes to the financial statements. So maybe by disclosing if you've had material unusual expenses, like for example, cleaning and sanitization expenses, to disclose that as an item in your operating profit note. And otherwise just in the management commentary in the director's reports or even in the notes to the financial statements to explain the impact that COVID has had on your financial statements, whether it reduced your revenues and your profits, etc. Another item that Nelia already touched on was just with regards to how to present. You might have, during the lockdown, you might not have operated for a couple of weeks, but you might still have been incurring overhead expenses like salaries and like rental. And the suggestion there then is, as Nelia has already explained, not to capitalize that to your inventories because you haven't manufactured any inventories during that time, and rather to not include those expenses within cost of sales, but to include them within operating expenses, and then just disclose in the notes to the financial statements the extent of those expenses. Okay, so the next item that I'm going to talk about is insurance recoveries. So entities may have claimed under business interruption insurance, for example, or I don't expect to see this very often, but also with regards to perhaps there were claims for, the damage to assets or whatever it is. So a couple of questions can arise with regards to this. The first issue is that an insurance recovery is a contingent asset under the statement IS 37, and you can only recognize a contingent asset once it is virtually certain that you're going to be receiving that money. And virtually certain means about 90%. So you have to be pretty certain before you recognize that insurance recovery as an income. Generally, this occurs only when you've received confirmation from the insurer that the monies will be paid out. And so generally, people should not be recognizing that income before that confirmation has been received. The problem with that is that if you've got a year in that is, for example, June, and you incurred, losses due to business interruption before year end, and you only receive confirmation from the insurer that they will be paying out after year end, that you're going to have a mismatch because your costs are going to be in one financial year, and the insurance recovery, that income, you are only going to recognize in the next financial year. But unfortunately, there is no way around that, and that is the requirement of the standard. For items for insurance proceeds relating to the destruction of assets. So the other consideration is also how are you going to present your insurance recoveries. If it does relate to an asset, then you offset the proceeds from your insurance against any amount that you've written off with regards to an asset. And for other types of insurance proceeds, like for example, business interruption insurance, you have an accounting policy choice to either present it as other income or to present it as a offset against the related expenses, but that would be quite difficult for business interruption insurance because it can relate, to so many items in the income statement. And so the suggestion there is to disclose it as other income. Okay, so the next item I'm going to talk about is an item that has affected a lot of people and a lot of companies during COVID and especially during the lockdown period, and that is leases. So what has happened in a lot of instances is that lessors have reduced or given rental concessions to their lessees, and the question then is how to account for those rental concessions, which is not as straightforward as you might think it is. You actually have to do an assessment as to that nature of that rental concession that has been granted. So for example, if we look at lessors first, because the accounting treatment differs between lessors and lessees. So for lessors, what you are required to consider is, first of all, whether any discount or any rental concession or deferral, whether that has been granted in terms of the existing terms of the lease, or whether it is actually as a result of a renegotiation of the lease and therefore a lease modification. So it can occur in terms of the existing terms of the lease if, for example, the contract contains a force majeure clause that states that if the lessee is not able to access the premises during a period of time, that no rental will be due. So the accounting for that type of a rental concession is to basically treat it as what we call a variable lease payment. But basically what that means is you just take it to the income statement in the period in which it occurs. So for example, if you have had to pay, if your rental per month is 100 Rand, and the lessor says, you know what, you were only able to access the premises during 75% of the month, and therefore your rental will be reduced by 75% to 25 Rand. That just simply means that you recognize 25 Rand income only for that month, which is really the desired outcome, because what you're doing now is you are matching the impact of COVID-19 to the period in which it actually occurred. So the other consideration then is when there has been an actual modification to the lease, and you actually had to renegotiate with your tenants new lease payments during lockdown. So the accounting treatment there is a bit different. So what you're required to do then is, as of the date of the lease modification, to recalculate all your future rental income, including the discounts, as at that date, and calculate a new straight lining amount and adjust your income on a straight line basis going forward. So that is not an optimal outcome, because what you're doing now is you've been granted, or you have granted your lessee a rental discount during the COVID period, and yet the effect of that is going to be spread over the remaining term of the lease, which could be, 9 or 10 years. So unfortunately, that is the required accounting treatment, although not ideal. So for lessees, so that is accounting by lessors for the income, and then when we get to the lessees in accounting for the rental payments, there's a similar assessment that needs to be done. So unless you use a practical expedient, which became effective on 1 June 2020 to IFRS 16, which I'll talk about in a minute. So again, if you're a lessee, you're going to do the assessment as well. You're going to have a look and see, is this discount that I've been granted due as a result of the existing terms of the lease, for example, a force majeure clause? And if that is the case, you take the effect to the income statement in that period. So now remember that under IFRS 16, the lessee would have raised both a right of use asset and a lease liability. basically at the present value of all the future lease payments. So if the lessee is then granted, let's say, a discount for a particular month, the required due to the existing terms of the lease, then what the lessee would be required to do is then just to effectively reduce that lease liability and take the other side of the entry to the income statement, which again is what you want, because now you are matching, your reduced expenses to the actual period to which it relates, which is when COVID actually happened. If it is not in terms of the existing terms of the lease and it is due to a renegotiation of lease payments, effectively what you will be required to do then is adjust the lease liability and the right of use asset. So again, you'll have to take your new rental payments as renegotiated, present value them, and you would have noticed most probably, unless there were just only rental deferrals, but you will most probably notice a reduction in the value of your lease liability at that date. And the other side of the entry doesn't go to the income statement, but it goes to the right of use asset. So you reduce your right of use asset. And then the effect that that has is that obviously you've reduced your right of use asset, and so your depreciation of that asset going forward is going to reduce. So again, not ideal, because now you are spreading the impact of COVID-19 over, the remaining useful life of the asset, which could also be a very long period of time. So
Sorry.
Sure.
I just wanted to add that this practical expedient is also only valid for leases up until, I think it's 30 June 2021. So that is, I think, the time period that it is applicable for lessees to apply, to use and apply.
Yes, so I'm going to talk about the practical expedient now. So the practical expedient basically allows lessees to not do that assessment, because lessees were complaining that some of them have thousands and thousands of leases, and to go through every single lease and to somehow, identify whether any modification to the payments is in terms of the existing terms of the lease or in terms of a changed, a renegotiated lease, that was regarded as impracticable. So what the ISB did is they said, right, we will add a practical expedient to IFRS 16, and this is effective for years beginning 1 or after June 2020, but may be early applied and early adopted. And what they've said there is, right, you don't, lessees, but it's only for lessees and not for lessors, is lessees can just assume that any renegotiated lease payments or any changes in lease payments, in fact, are not due to are in fact due to attributable to the existing terms of the lease, and that you can therefore take the effect to the income statement in the period in which it occurred. And I think a lot of people have been making use of that practical expedient, because that ultimately, that I think is, for most people, I think will be the most desirable impact. So as Carolina just mentioned a minute ago, thank you, Carolina, that practical expedient can only be used in certain circumstances, or at least 3 conditions need to be met before you can actually apply that practical expedient. So as Carolina pointed out, one of those requirements is that the rental payments or all of the renegotiated rental payments must occur before the 30th of June 2021. So the second requirement is that your renegotiated lease payments must be equal to or less than the original lease payments. If there's been an increase, you can't apply the practical expedient. And then lastly, that there should be no other changes to the lease agreement. So, you can't renegotiate, there couldn't have been a renegotiation, and as part of that, for example, a renewal option was added to the lease. If that happened, it means you can't apply the practical expedient. And so effectively, you'll need to adjust both the right of use asset and the lease liability.
Susanna?
Yes.
May I add a question here just on the leases? So is there a difference in accounting between if a lessor gives you a a rent reduction versus a deferment of the rental payments? How does that impact this?
So I think that, in terms of the application of the practical experience, if the lessor gave you a rental reduction, or if they gave you a discount, or at least a deferment of rental payments, you will still be able to apply the practical experience. Practically though, what you will find that if there has been only a deferral of rental payments, that there shouldn't really be any impact on your lease accounting in terms of your lease liability and your lease asset, because your payments are still what your payments are. There might be a small adjustment because you need to again reperform the calculation of the present value of the future lease payments, and because you are paying later, there might be a slight interest impact which will hit the income statement, but mostly you will find that there is not going to be a big adjustment as a result of that. But the same principles in accounting for either a deferral or a reduction of rental will apply under IFRS 16.
And then what about a case where you already owe the rent and they've forgiven the whole amount or part of it? Does that change?
Yes, so there is a view that if the rental is already due and the renegotiation takes place after the rental is already due. So for example, your rental was due on the 1st of April and the lessee only realizes, sure, but I can't pay. I can't pay this rental in full, or I can't pay it on time. Then the lessor will be required to do a calculation of expected credit losses. So basically it will assess that amount for bad debts. It would have recognized the rental in full, but with regards to the receivable that was raised, it will, if necessary, it will write off that receivable as a bad debt.
Thank you.
Okay, so the next item I'm going to talk about is borrowing costs. But what is relevant here is if companies are constructing assets during the COVID period. So under the borrowing cost standard, if you're constructing, let's say, buildings, and the asset in question has to necessarily take an extended period of time in order to complete it, or to complete its construction. If that requirement is met, then any borrowings that you would have taken, or at least any borrowing costs on a loan that you would have taken out to finance that construction, should be capitalized to that asset as the construction progresses. So of course, COVID would have thrown a bit of a spanner in the works, because there might have been a period during the lockdown period that construction would have needed to cease. And there is a requirement in the borrowing cost standard that states that if the active development of the asset is suspended for an extended period of time, that the capitalization of borrowing costs should cease during that period, and then they are expensed as incurred. So that is maybe to consider. Unfortunately, we are in the situation again where IFRS doesn't give us a lot of guidance on exactly what is regarded as an extended period of time, and that will be up to a company's judgment. So there has been a bit of guidance around that with regards to factors that can be taken into account in assessing exactly what is regarded as an extended period of time. So one of the things that you may consider is, for example, if it's a relatively short contract. So let's say the contract is only a 6-month contract for the construction of the asset, as opposed to maybe 36 months or however long. If you then assess your lockdown period, let's say you were not able to continue for about 1 month, 1 month out of 6 months might be seen as an extended period of time. Whereas 1 month out of 36 months might not be seen as an extended period of time. One of the other factors that they've suggested you consider as well is the remaining period of the contract. So if you had a very long contract and it has only 3 months left to go, and all of a sudden, for 1 month you can't continue with the development, then you may also regard that as being an extended period of time. So it will very much depend on the facts and circumstances of each case.
I think what is also important to remember in this is that it cannot be a blanket approach for all your qualifying assets. You'd need to look at them independently.
Thanks, Justine. Okay, so the next item I'm going to chat about is government grants, and this might be applicable. I think the government, as well as other non-for-profit organizations in South Africa, gave a lot of entities grants to assist them during the COVID-19 period. One of them that I can think of is, for example, the Tourism Relief Fund that granted tourism entities, a relief of about up to 50,000 Rand. There was also the SMME Debt Relief Fund. And then I'm going to chat a bit about the Unemployment Insurance Fund as well, in terms of their TERS program. So the thing to consider with government grants is, well, first of all, when do you recognize your grant that you're going to receive? And it's the hurdle here for recognition is quite a bit lower than for contingent assets. So for insurance recoveries, remember we said that you need to be virtually certain before you can actually recognize that income. For government grants, you just have to be reasonably certain that you will comply with all of the conditions of the grant and that the grant will be received. So once those conditions are met, you can recognize your government grant already. So the other thing to consider then as well is how are you going to present your government grant in your financial statements. That really depends on really an accounting policy choice for the company, because the standard gives you the choice to either recognize it as income or again to offset it against the related expenses. You recognize the aim with recognizing the government grant in the income statement is to match it with the expenses that it was intended to compensate you for. So what that means is that if you've already incurred all of your expenditure and only then afterwards receive or recognize your government grant, then you recognize it in revenue immediately. Otherwise, you defer it onto the face of the balance sheet and you amortize it to the income statement in order to match it with the related expenses. One of the exceptions to that is TERS granted by the UIF fund, and the requirement for that is, at least the view there, is that when the company receives a TERS payment from the UIF, it is actually not receiving it in its own right, but is receiving it as an agent on behalf of its employees. So what might have happened is that your employees were not able to work and you therefore did not pay your employees, but that an application was made for a TERS grant and that was then paid over to the company, who then pays it over to the employees. In that case, the receipt of that TERS grant is offset against the salary costs, because you are in fact, or at least the view is that the entity is in fact only acting as an agent on behalf of the UIF in paying over that money to the employee. Okay, and then we get to the last topic. The last topic is contingent consideration in terms of IFRS 3, and what this relates to, or what it might relate to, is where a company previously acquired a business or it previously acquired another company. So what often happens is that there will be earn-out payments that are due in terms of these types of acquisitions. So say, for example, you purchased, or at least you acquired the company and the purchase price was 10 million Rand. You paid your 10 million Rand at the time of that acquisition, and that is done. But the agreement also contains a clause that says that if, for example, that company achieves a certain EBITDA over the next 2 years, that an additional payment of 2 million Rand will be due. And the accounting treatment requirement, or at least the accounting requirements for that, is that the company should actually raise that the company that incurred the acquisition, it must raise that 2 million rand payable at the time of the acquisition already, even though it's only payable later at a period in time. The amount should be raised at fair value. So, for example, if the contract says that you possibly need to pay 2 million rand, the company should be doing its own probability weighted average calculations, and it should be taking a couple of other factors into account, and it should be arriving at a fair value for that consideration. And so let's say the company did those calculations and it came to 1.5 million rand is the fair value of that future payable. That 1.5 million rand is added to the cost of the acquisition and then is subsequently adjusted sort of up or down as your estimates change and as you sort of go forward and reach the period during which the payment must be made. What might have happened is that when COVID hit, these companies might have realized that there is no way that these EBITDA targets are going to be met, and there is therefore no way that this additional 2 million rand will in fact be payable. So then the question is, what do you do with that payable? And the standard requires you to reverse that payable to the income statement and not to the original cost of the acquisition, which seems a bit counterintuitive because you originally raised it to the cost of the acquisition, but the requirement is to reverse that liability as a fair value adjustment through the income statement. So we might see quite a bit of that happening where acquisitions were involved. Okay, and Justine, I don't know if there are any questions, but if there aren't, then I'll hand it back over to you.
I think, Susanna, there is one question on insurance. Anonymous says that if the insurer confirms after year end, isn't that an indication of the fact that it existed at year end?
Yeah, so I think we're going to see that question coming up a lot, but the standard actually, it does unfortunately prohibit you from, if you only receive the confirmation after year end, to sort of go back in time and recognize that at year end already, because it requires you to keep reassessing the contingent asset and only recognize it once it has become virtually certain. So unfortunately, you cannot apply that retrospectively.
Thank you, Susie. I don't see any other questions at this time, but we'd like to give a few minutes open for questions. So please feel free to include any questions on the list. We'll give it, another 3 minutes or so. Obviously, if there's more questions, we'll give it longer, but if it's silent, we'll wait for 3 minutes. I think for me, while we're waiting for questions, I think for me, the key to COVID and your financial statements is that you must tell a story. Tell your shareholders what is going on. Tell your readers what is happening. How has COVID impacted you? How is it impacting you on a continued basis? What are you expecting to still come through? And one of the big questions we always have is, how much do I include in, and how much is too much? And it's a very difficult question to answer, and every company is different. It depends again on your shareholders and your readers and what they're needing. But the essence of everything is that your financial statements tell a story, and you need to tell your readers of your financial statements what is really happening in your company and help them to make informed decisions on it. Because if you are looking at your business at the moment and saying, well, actually, we might need to close down certain sections, but we don't want to tell the shareholders because then they're going to freak out, and be very careful of those assumptions and tell the real story, tell the proper story, and make sure that that story is consistent throughout the financial statements. I was reviewing a set of financial statements the other day where the CEO report said everything was still hunky-dory and on track. The CFO report said, well, you know, they are looking at selling these entities, and there's could be a concern there. And then the financial statements, they had these massive discontinued operations, so that they weren't telling a consistent story, and that is one of the essential things to pull throughout. And people want to know what is happening on COVID, what is really going on in your business, and how are you mitigating it? And that's another essential thing that needs to come through. Is I know with the lockdowns and the potential that there might be further restrictions coming in, that can impact your business. What are you doing? What are you doing differently? Because this is a time of disruption. What are you doing differently to try and countermeasure the impacts that are happening, and to make sure that your business is sustainable through everything? And that for me is the key story that needs to come across in your financial statements. All of these things that we've spoken about today are impacts on your financial statements. It impacts your provisions, it impacts your revenue. These are all expected areas that we expect to see impacts. But people sometimes they adjust for those, but they don't talk to it and say that actually it's a COVID impact, and this is why this is happening. So do watch out for that. Do put that disclosure in and explain, so that it's not then expected that this is just a normal run-of-the-mill impairment. But what's very important in that as well is that just because you've now got a goodwill impairment due to COVID, it doesn't make it an exceptional item. It is still part of your operating profit and loss at the end of the day. But when you explain it, so you won't move it in your income statement, but you will explain it in your notes and wherever else you disclose it. Okay, I see there is another question coming here. It says, in terms of disclosures, do we need to disclose a paragraph regarding COVID-19 under Director's Report and under the notes, or only under one of them for IFRS for SMEs? So I don't know if anyone else would like to take this question, otherwise I can. Okay, I'll take it. Okay, so on this question, and you'll notice a lot of what we've spoken about today under IFRS is also very applicable to IFRS for SMEs. I think the only different one was the revenue. The rest are still do impact IFRS for SMEs. But on the disclosures, there's no specific requirement as to where you have to disclose it. What we do know is you do have to disclose it. I always like to think of the Director's Report as your executive summary. So this is where you should explain some of the details, and a lot of clients often put the details are explained in the annual financial statements and no further explanation is required. I'm like, oh, well, actually, you've had huge ups and downs, and that the Director's Report is where you explain those ups and downs. And then in the notes, that's the COVID requirements often come within your subsequent events notes. So you could have it in both, but be careful of absolute repetition. Try and tell the same story, but don't say exactly the same thing in both notes. I don't know if anyone else has any comments on that.
Steve, not maybe exactly repeating what you've just said, but the one question that I've had a lot of people asking me is, okay, so I'm looking at a June year end. COVID is done. So there's no more lockdowns relating to my business. So it's an adjusting event. Why do I need to disclose it? And I think everything that you've said is so important, because it's still important to explain how exactly COVID has impacted your business. Just because it's an adjusting event doesn't mean that it doesn't exist. It still impacted you. And even if you're in one of the very few businesses that were not impacted by COVID, I would expect at least something in the financial statements explaining why. We're living in such a drastic, different time. A year ago, none of us would have expected that anything like this would happen to us. Your financial statements need to tell that story.
Okay. Thank you, Sonika. So I'm not really seeing any more questions come in at this point. More thank yous. So I guess thank you very much for attending today's session. If you do have any more questions, you are welcome to email us. We've ended a bit earlier because, well, we're not getting as many questions as we'd hoped. But please feel free to contact us should you have any further questions. And with that, then we'll be wrapping up this live event. Thank you very much for attending.